Hello everyone, this is Alan Beaulieu, President of ITR Economics. Glad to be with you today, and today's Trends Talk will be about a tale of two houses. We're going to be talking about China, and there are two very different things going on in China that I want us to talk about. In the end, we're going to see that it really depends on who you are in terms of doing business with them. It's going to depend upon which side of the economy you're selling into, but overall China is feeling the impact of their own decisions. They're feeling the impact negatively of past decisions. They're feeling some good things from stimulus. They're feeling some pain from tariffs, but overall it is certainly easily divided between the two houses. Let's start with the positive side. China's leading indicator, 112 rate of change, has been rising since September 2018. That's a great signal. We like to see that. It means good things are happening. And the positive house is the consumer side. It's pretty amazing, as a matter of fact. China's Consumer Confidence Index for April is just shy of a February 2019 record high, which was the highest it's been in 29 years. This is a composite index of expectations and satisfaction. So it's a measure of consumer satisfaction with the current economic situation. And so the consumers, despite the troubles going on in the other house, they probably don't know they're going on. Despite all the concern about tariffs and debt and banking and other things that are happening, they're happy with what's going on. They're very confident in the economy, and that's bringing them into a spending mode. They are able to spend because wages, as of the end of 2018, in manufacturing anyways, the average annual wage in manufacturing as of the end of last year was up 11.8% year over year, and had risen to the highest level in 6.5 years. Certainly good news. Consumer goods, total retail sales of consumer goods were at a record high in RMB, 5.4% above year-ago levels, rising in Phase B. That certainly is good news and encouraging and would bode well for the economy. Consumer spending comes to about 35% of the economy, so it's a major segment. Consumers are feeling good, they're earning good money, and they are spending, which is really a positive thing. And there are some segments of manufacturing which are doing well. One very notable one is color TV production. It's kind of a ubiquitous in this country to think all TVs are made in China, so that's why I chose that one. It's at a record high level of output. The rate of growth, though, is in Phase C, decelerating rise. And the 312 rate of change, the quarterly year-over-year growth rate, is just at 3.2%, also in Phase C. So it's in 3.2 for this category is rather thin. So in this strong part of production, we are seeing some deceleration. The problem part of the economy in China is found on the industrial side. China's Purchasing Managers Index, which deals with that industrial side, specifically manufacturing, and it leads industrial production by 11 months, may have established a low in January, but I don't think so. It doesn't look like it's going to hold. And the 112 rate of change is the same. It doesn't look like it's going to hold. That means that the softness that's in China's Industrial Production Index right now is likely to last through the rest of this year and into 2020, much like the United States. While the IP, the Industrial Production 12-month moving average, is at a record high, the rate of growth is 5.9%. And that rate of growth at 5.9% is the lowest in 22 years. So whether you believe the number is real or not, the numbers are showing that the economy has slowed down very noticeably from their perspective. And as it has slowed down very noticeably from their perspective, we grow concerned about the industrial side of the economy. And I think you will too when you hear that China's industrial profits are at a 6-year low. That's not good. It doesn't help with capital expenditures. It doesn't help with repaying loans. It doesn't help with future plans. When we drill a little deeper, we look at just the manufacturing sector. Profits are at the lowest in 4 years. Dig a little deeper, we find that automobile manufacturers' profits, which leads industrial production by 7 months on a 12-12 basis, the actual profits in RMB is at the lowest in 5 years. The 12-12 is a record low, 18% below year-ago levels. So the automobile industry is getting hammered. And by way of comparison, by the Great Recession 12-12 low for automobile profits in China was minus 2.9%. So the minus 18% is a big deal. And automobile production in China is down 12.8% on a 12-month moving total basis from the June 18 record high. The 12-12 rate of change year-over-year comparison is at a record low, minus 11.9%, and is still declining. They produce a lot of units, don't get me wrong, 26.5 million units being produced in China, but it is certainly going in the wrong direction for the economy. And selling into that market, if you're exporting from the United States, is difficult because of tariffs, and it's also difficult because of the decline in demand. By way of comparison, in case you're interested, automobile production in the United States is 10.9 million units versus China's 26.5. Other problems are abounding in China too. Exports, the manufacture of manufactured products has stalled. It's just down ever so slightly off of January 2019 record high. The year-over-year growth rate is at 4.8% in phase C, so things are slowing down in exports, very important part of the economy, as I'm sure you know, about 20% of GDP. And consumers, while they're happy and they're feeling good in their spending, they must be feeling some pinch. I can't imagine they're not, because the food consumer price index is up 7.6% year over year. That's got to hurt the lower income and lower middle class part of the population, same as it would here. If your grocery bill was up 7.6% year over year, you might not notice a lot, but there is a large part of the population where that would be certainly a big deal. And we're going to wrap up that negative side of the house with the foreign direct investment contracts are off 12.5% year over year. They're down 12.5% off of a December 18 20-year high. It's a steep decline. It's a very steep decline, showing a lack of confidence and a lack of future build in China, at least through the near term. So we have two houses. The consumer side, doing well, feeling well. And then we have the industrial side, feeling a lot of pain. Overall, expect China to continue to slow down along with the United States into 2020. I'm Alan Beaulieu. I hope you have a good day. Thank you for listening to ITR Economics Trends Talk.